Right. Is bridging something that you're involved with at the moment, Alistair?
Right now, there's two types of bridging I'm involved in. There's open-ended bridging, whereby, in effect, you get money against an asset, generally 75% to the maximum, and then you do whatever you intend doing to it. And more often than not, open-ended bridging, there's a 12-month term, and you must exit either through selling the asset, refinancing, typically the two outcomes for exit. The other type of bridging we are becoming increasingly involved in is the bridge to let product, where there is a bridge day one. It's designed for light refurb proposals, but more importantly, it comes with a guaranteed exit against the post-refurb value. And that is becoming an increasingly popular way to get around the habitability issues. If you're buying a property where perhaps it's not lettable, the bridge to let product may work because they'll give you 75% of the day one value. You undertake the refurb, the cost of the refurb you fund yourself, but the same lender will exit the bridge with a guaranteed exit against the post-refurb value.
Indeed, indeed. And it's great to see that lenders are now coming up with products like that. I mean, back in the day, there were things called light refurbishment mortgages,
Yep.
which disappeared, but it was essentially the same thing in effect. Maybe a little bit different because it wasn't technically a bridge, but it was all part of the same product. And the great thing about the bridge to let product is it is literally one product, one application. So you have that certainty. If you're not going to qualify, you don't get the money. So it's not like you go and buy the property on a bridge and then have 6 months of sleepless nights wondering whether you're going to get a buy-to-let mortgage at the end of it.
Although it's not without risks, I will say.
Okay.
The main risk element after you've drawn down the bridge is make sure you get the refurb work done within the 6-month period, ideally within 4 months, because even when you're finished, you still have to get re-inspection, and there's still a remortgage process. Even though it's with the same lender, there's a remortgage process from the bridging division to the buy-to-let division, and that, despite the fact it's with the same lender, it still takes 4 to 6 weeks. So with any bridge-to-let case, it's absolutely vital that you're able to get the refurb works done pretty quickly. And that all comes down to having a decent team, a reliable team, and being able to get them in and out fairly quickly. So you get in, you do the work, and you exit the bridge as soon as possible.
So going back to traditional bridging, what sort of rates are people paying for bridging loans at the moment?
Well, for open-ended bridging with no guaranteed exit, you're looking at anything up to 1% per month, Peter. The lower the loan to value, the lower the rate. But if you're looking at borrowing up to 75%, 1% per month, you'll be able to shave that a little bit, but to factor that into your costs would probably be a decent figure.
Yeah. And of course, with bridging, you also have fees on the way in and you have fees on the way out usually?
Usually you do. Not all lenders charge exit fees. But the reality is the lenders that don't charge exit fees either bump up the fees going in or they bump up the monthly interest going on. Generally speaking, most lenders will charge 1% minimum as an entry or an arrangement fee. Most lenders will charge some form of exit fee. Typically, that will be lower, 0.5% on average.
Yeah. And of course, one of the questions I'm often asked is, well, why would you even do that? It sounds expensive. But the reality, as we said, it's a habitability thing often, isn't it?
It's not only just a habitability thing. It's, for example, if you're doing a large-scale development and you can't access high street development funding, generally speaking, high street banks are, in my experience anyway, they're not that keen on what they term small-scale developments. They want the large, chunky stuff with all manners of professional advisors involved. Bridging loans can work for smaller scale developments where maybe the borrower doesn't have the experience that high street banks expect. So it does work well for that. But when you go into a bridge, the number one priority is having certainty of exit, because bridging can be very expensive. And if you go beyond the terms of the bridging loan, then you run the risk of default, the lender coming in, repossessing all the property very quickly, and coming after you for any shortfall.
Yeah, well, I mean, they can be quite brutal, can't they? I took out a bridge a while back where if if I'd gone over the period, the interest rate would have gone up, but then the terms allowed the bridging lender to actually add that increased interest onto the money I'd already paid. In other words, they could backdate it to the beginning of the loan, even though I'd been paying them a lower rate of interest during the loan. They'd have treated the whole loan, and they can do this because they can.
Yeah, it's for unregulated bridging, absolutely. There's no question. I have seen some horror stories of bridging loans gone sour. But I suppose from a bridging loan company point of view, it's a very risky lend they're doing. So they want to make sure they're fully protected, and in the event of default, they're going to get their money back plus more in some cases.
I hope you found this video useful and informative, and if you did, then please come over to my website www.thepropertyteacher.co.uk, where you'll find loads more great property related resources, including free special reports to download and my best-selling series of ebooks, which includes the Successful Property Renovators Workshop, 63 common defects in investment property and how to spot them. And if you're just starting out in property, or if you want to grow your portfolio, you may be particularly interested in the Successful Property Investors Strategy Workshop, in which I'll take you through exactly how I started and built my property portfolio, starting literally with none of my own money, and how I built a portfolio of £2 million worth of property in just 4 years. And that was starting from scratch. I'll take you through everything that I did right so that you can copy me and do the same. And I'll also show you everything that I did wrong so that you can avoid the mistakes that I made, and so that you can progress in property and be far more successful far more quickly than I ever was. And this is based upon my own real life experience, and it took me about 4 years to actually work out how to do property investing properly. But in the 200 pages in the Successful Property Investors Strategy Workshop, I'm going to show you all of that 4 years knowledge condensed down so that you can use it immediately. And until next time, here's to successful property investing.